Hey everyone, welcome back to the channel, your number one source for income-oriented investing. I'm back with Mr. Jay Pestricelli from Zega, who we know is the brains behind YieldMax ETFs, Defiance ETFs, well, the income ones anyway. Welcome back, Jay. How are you?
Yeah, great to be here, Adrian. Thanks for having me.
I'm
I like the way you say my name, Pestricelli. You give a little oomph on it. I like it.
Yeah, for sure. I think that's how you're supposed to pronounce it, right? The
It
real
is, it is,
Italian
but
way.
you
We've
know,
had
I
this
live in
discussion
America. What do you
before,
want
I
to say?
think.
You got it. You got it.
All right, so I want to cover the new series of that YieldMax has come out with, the Target 12, the Target 12. So right now, as of now, you guys have two of them. I'll share my screen just so everyone could see what we're talking about. So we're talking about these ones here. If you go to our ETFs, you have the Target 12. You have BIGY. I love that name, by the way. BIGY is on the Target 12 Big 50 option income ETF. And you also have SOXY, which focuses on semiconductor stocks. So let's talk a little bit about why you guys decided to launch this new series. Tell me the premise behind it first, and then we'll dig deep into Biggie and what that one's all about.
Yeah, absolutely. So the premise behind these is we know that we've heard a lot from the community and from your community specifically that hey, like we want growth as well as income, and while we think we do a decent job of capturing growth on a lot of the yield max products, the primary goal of those other products is yield. Well, in this case, we still want to capture yield, but we will define it. And by defining the yield, it's weird, I'm going to limit the yield, it unlocks more upside capture and growth if the market is moving higher. And so by creating what I'll call a specific level of income, like in the cases of these funds, sorry, it's 12%. We are only going to go for 12%, and the rest of the effort is capture the upside movement of the market in these particular individual levels. And so individual tickers. And so the idea on this is define your income, tell people what that income is going to be. Our target is about 12%. We say 12, it could be plus or minus. Some of the holdings have dividends, all those things work in. And so after that, though, go make more money. So instead, more growth. So instead of having max out as much yield as you can, it's define the yield and then capture upside. And we did this in this first round of tickers here that we're going live with. We did it because we thought it's more of it's almost more of an institutional type product, right? It's more of the kind of product that an advisor that's managing an overall portfolio, they don't need the uncertainty of what is it, 50% this month, 20%, 100%, whatever the movement around that's so exciting about some of the single stock yield maxes are. They want, hey, I want to know and I want to plan for a portfolio, I want to plan for my income level. You tell me 12% and the rest is growth. Great. Like that is a little more traditional thinking versus,
Yeah.
the what yield max single stocks do.
Yeah, it's super interesting. So, yeah, finding that balance between income and growth. So, like you said, it's not just give me maximum yield anymore. Let's target 12, which we know that the S&P 500, let's just say the average returns is approximately 12, something like that, 10 to 12 in the last, I don't know, 40 years. I think it was 11%. So, let's talk about Biggie here. So, Biggie is the first one that was launched. To me, this kind of looks like a 50%, a concentrated version maybe of the S&P 500. So there's 50 stocks in here. That's why it's called YieldMax Target 12 Big
Yep.
50 Option Income and ETF. So general information are these, or Biggie has, I believe, the same expense ratio as the other YieldMax ETFs,
I believe so.
99.
Yep.
They're monthly distributions, right?
Yes, the number 12 was picked for obvious reasons, right? Yes, we left that at 1% per month as the target for the distribution rate, and they will be monthly, not every 4 weeks, like the
Okay.
singles.
And here's the Excel sheet with the stock selection. So I highlighted all the 50 stocks. The other ones are the calls, I believe. So you have, it looks to me like a concentrator or like a mini S&P 500. A lot of the stocks you recognize here. It's right off the bat, I could tell it's diversified within sector. It's a top, very big known companies in the US here. So you have Pepsi, you have Oracle, Netflix, et cetera, et cetera. It really looks like a little mini S&P 500. I noticed that there's no synthetics in here. So this is a bit different from your other YieldMax ETFs where you're getting the exposure synthetically. In this one, you're actually holding the stocks and then writing the necessary covered calls, I believe, to get to that approximately 12% annual yield. Is that correct?
Yes. So there's a few reasons for that. So you are correct. We're selling calls and call spreads. You know us with our call spreads.
Okay,
We
so
love
call
those.
spreads
Those,
as
by the
well.
way, yeah, yeah, for sure.
Okay.
Like even in what you just showed, there were call spreads, I think, on the AbbVie position you were just showing. And so the idea here is, so you're right about the selection, as the name indicates, they are large cap funds. It's not the biggest 50, like we left Berkshire off because that's just basically other big caps in there, right? So there's some selection that goes on there, but you're right. We own the underlying stock because we don't want to be in the position like we do with the single stocks that use synthetics, where we are forced to have regular rolls, right? Where we're forced to, hey, every couple months, the synthetic expires, realize the gains, you might have a lot more distribution. So the idea here is, with this owning the long stocks, we should be able to provide some NAV stability. That's the objective there because we don't have realized gains. This portfolio, doesn't necessarily even has to be rebalanced all that often, right? This is the first one. We haven't had a rebalance yet. It's only live a couple of weeks, but the point is it's probably, quarterly every 6 months. So, and those will just be, little maybe rotation there. So we're trying to avoid having to over distribute. We want to stick with that target 12 because we think it helps address some of the questions that, people have around, NAV decay or NAV decline versus NAV appreciation. So it makes it a little easier. And the reason we could do it is because the portfolio is, as you said, naturally diversified,
Yeah.
right? So in an ETF, you have some limitations on what how much concentration you can have in a single stock. That's why we run the synthetics and the other yield maxes. But here, it is more about we don't have that so much as a problem. We can own the long stocks. We can own them and not realize the gains in the positions, which would force excess distributions over a target 12.
Makes sense. Tell me a little bit about the stock selection. Do you envision it changing much, or it's going to be these 50? Can you add some? Can you remove some? What would make you make that decision?
Yeah, we have the flexibility to adjust that portfolio. I don't see there being any near-term changes. It won't be active like Ulti, for example, right? It won't have a large. This is the portfolio. You should expect this to be the portfolio for the foreseeable future. Yes, there might be stocks that maybe drop in and out, or maybe drop out of there because their market cap would have shrunk, or maybe a different stock would have grown in market cap that we want to put in, but it would really only be under circumstances like that. The criteria, we don't disclose all the criteria, but you should use market cap as the name indicates as the idea behind what is picked, and the portfolio isn't going to be that actively rotated. Those are the stocks.
Yeah, they look like, the big important US giants to me.
Yeah, yeah. Which is, like you said, we like it because it is kind of a mini S&P. It's I would say it's a competitor to other S&P covered call ETFs out there.
That you took the
Sure, you
words
could
right
name
out.
a few.
Yeah, you took the words right out of my mouth. Definitely, you're gonna get more growth for sure if you're targeting 12. I mean, so let's talk to me a little bit about the covered calls on the covered call strategy. Do you have entire flexibility? Are you just writing calls on all 50 stocks? Are you doing this actively? I'm assuming they're going to be mostly out of the money calls. Like, what's the difference between the other yield max ones, which are like weekly, they're out of the money, they're weekly, more, aggressive cover calls.
Yep. Yeah,
Um,
sure. This is a little more standard covered call approach
okay.
with selling monthly covered calls. Like if you look at the expirations, we're in the December monthly. We've actually even already rolled some to the January monthlies. I think there's 10 positions in January. And we've already just only been live a few weeks. So they will absolutely be actively managed. We will
Mhm.
be selling the calls with that target income in mind. Because we have this target income in mind, you can go a month and not worry about having to, do the highly active trading that we do with weeklies in the single stocks. Because again, we're not going for maximum yield on this, we're going for a targeted yield. So why not go a little farther out, give yourself a little more room to the upside of the initial capture, and then we are still using spreads. It gives us a chance to roll those early. They're not all spreads, they're not 100% spreads, but we're definitely using that tactic as well. And then you asked, do we do it on every single stock? We don't have to do it on every single stock. We don't even have to do a full allocation of shares versus the number of options we sell. The only goal, the real goal we have is make 1% per month, right? So we could do it on 30 stocks and let 20 run uncapped. You could do it on all of them. You could concentrate it on 2 or 3. That's probably not what we're going to do, but we have the flexibility to make that discretionary call.
Awesome. Yeah, I was just gonna ask you, is it 12% annually? But you just said we're targeting 1% a month. So let's say in a given month you do 2%, or the next month maybe you don't write covered calls. Like, how are you guys deciding how to go about that? Or is it really like, let's do 1% a month, guys, with the most out of the money calls that we could do just to get that threshold and then capture as much growth as possible? Like, what's your thoughts?
It's interesting. No, so we are really aiming for just 1% per month. We want to spread that out over time. Like if we could get 12% 1 month and then have 11 months with no upside, with no calls, no, we're not going to do that. We will do, our target is 1% per month, and with the structure we're building, that gets defined pretty well, right? When you sell an option, you know what your income is going to be. Best case scenario, that option expires worthless. You keep that money. That premium that we sold that option for is defined at 1%. That's where we start. Now, like I did say, we do some rolling and moving up, and we'll be active when a call is in the money or has no more extrinsic. We're gonna roll early. We're gonna take advantage of that we might have earned our extrinsic early, or if it's in the money we don't want to get assigned, we'll roll those early. Again, all around the premise though of making the 1% target per month.
Okay, and it's 1% of the NAV, right? I'm assuming.
Yes.
Oh, okay. So
Yeah, we look at the whole. Yeah. Oh, right. So it's not 1% of that stock. We look at it as the whole fund, right? So if the fund is $10 million, we want to sell premium for that month. That makes us $100,000.
yeah, yeah. So 1% a month equals 12% a year. And what about the distributions? I'm assuming that if the NAV just keeps the distribution should be more stable than the other YieldMax, because this is a targeted. Obviously, it's not going to be perfect month to month, but let's say the NAV is going up gradually, which I believe it could or it should over time. We're going to expect maybe slightly increasing distributions, right? Because if the NAV is bigger, now that 1% is bigger, so you should have increasing distribution. Tell me about the distribution policy.
And that, by the way, that's very true for any of the YieldMaxes, but you're totally right. So let's say the NAV goes from 50 to 55, or let's say the first month it says 50 all the whole time. We end up distributing the 1%. In that case, would be 50 cents.
Yeah.
If the NAV then is 60 a month later, we should be distributing 60%, 60 cents, I'm sorry, which is still that 1%. And that's because the fund has grown and we're selling premium against that asset size per share, right? That's how NAV works. It's the value per share. So that scenario, we would be selling for more premium. We'll distribute the premium that we earned. And then it works the other way too, unfortunately. If the NAV goes from 50 to 40, then you should expect 40 cents in that month, right? I mean, we really do want to target that 1%. So it could be a little higher on the down move. It could be, a little lower on the up move because it takes time, right? NAVs don't go from 50 to 60 in a single day. They take time to grow. While we are selling calls along the way, we are adding and adding and adding to the amount of premium we're trying to make. But still with the idea of come the end of the month, we want to be able to say, okay, we made 1% of premium, distribute that.
Yeah, I think this is genius, honestly. I mean, the target, it gives investors, I definitely think this is more for maybe retirees, people who want a more consistent cash flow. They want it consistent. They don't, want their net asset value, their stock price to go down too much over time. I think this is a perfect solution because 12% is approximately the return annual of the S&P 500. So more or less your capital should stay stable, and if the markets go up, it should go up slightly. But the opposite is also true. So if it goes down a little bit, well, you're giving out a little less income. So there should be a lot of stability. So I find this is really good maybe for retirees, people who want that consistent income. They want their capital more or less preserved and in high quality blue chip US stocks. So
Yeah, I mean, you should have lower volatility here
lower
than say
vol
the
for
single
sure.
names,
Yeah.
right? Like it's obviously going to be lower volatile, less volatility than, you know, Nvidia,
Yeah.
or
Just Nvidia or just MicroStrategy or Coinbase.
right, right. Like you picked that one. That one is crazy, right? But that's a fun one to always talk about. But that one's not even in this portfolio. But the point is, you're right. You now are going to have something that has the vol more of the S&P of the market versus single stock risk, which some people like the single stock risk, of course. Some people want stability. I think the other point here that we're trying to achieve is, stability in the NAV, right? We've
Yeah,
gotten feedback about that too, that's really important. It's not only about total return, it's about the return of the NAV, price return too. So that should be, again, providing that the market does what it normally does. But even if you get a nasty year, if you take a 2022 or even 2020 or even the end of 2018, in those scenarios, this is going to behave more like, large cap stocks versus say a single volatile ticker.
for sure, for sure. Definitely less volatility. It's with that diversification as well.
Yeah, and you hope that the idea here is that also the income from the calls will, I don't use the word buffer, maybe
Cushion.
lessen the impact of a volatile market too, right? Because you've got some income that's coming in here. It won't, it's still just 12%, but look, that can help if you could generate 12% in the declining market against the minus 20, minus 25. It should be additive, right? And have you potentially lose less than what the market is losing in a down year.
Yeah, yeah, for sure. So you have BIGY. You also have SOXY. I don't know if that's how you pronounce it, but
Yeah, we
whatever.
call it SOXY.
SOXY. So this is the same concept, Target 12, but it's on a collection of semiconductor stocks. Like it says here, I think it was 15 to 20 or 15 to 30 semiconductor stocks. So, and I believe, hopefully you could see my screen here. This is a
Yep.
filing for other ones. So obviously SOXY is here, BIGY is here. Looks like you have one biotech and pharma, energy, real estate, tech and innovation. So one that's technology specific, energy specific, healthcare, biotechs, et cetera, et cetera. So are these pretty much the same strategy as what we discussed already, the same concept, same premise about the distribution, the target 12, et cetera, et cetera?
Yes, with the added feature of these are more of a theme,
Theme,
right?
yeah,
So now it's
thematic,
more
yeah.
of a theme, more of a thematic play here. So same option tactics. The selection criteria now is obviously, focused on a theme or a sector versus just the broader market. But you got it. Everything else is the same here. And there's some interesting items here. And look, again, it's to the point of you look at the success of other products that are out there that thematic ETF investing has obviously had plenty of success over the last decade. So this is the idea of like, hey, you could get a YieldMax product with this target income added to a sector that you might like. Semiconductors obviously are a very popular sector right now, but we
Yeah,
think we've given ourselves some other things that are a little unique here, right? Or I shouldn't say unique, distinct, right? Real estate with income here, with the option overlay income, or you look at energy, right? So while these are certainly you could find sector ETFs that provide that exposure, running covered call strategies over them is another way to be additive if yield is your goal.
yeah. Maybe a crypto one would be good. That would be maybe a suggestion. I know RexShares just launched their own crypto, so it has a MicroStrategy, it has Palantir, I believe, Visa, anything crypto related, Marathon. I think that would be an interesting one. A Target 12 on that would be cool. That's just
Yeah,
my
we have
opinion.
filed for not a target version of crypto, but a different version of kind of a crypto yield max approach where kind of it's a portfolio. And that's not live yet, so I can't comment too much about it yet, but there has been a filing for kind of a crypto and an AI focused, yield max build as well, and some
I'm
others.
Awesome. That's great. More options, the better. I'm just curious, Jay. I don't know if you have an opinion on this or not. What do you think of the crazy rally in Bitcoin and MicroStrategy? I mean, Michael Saylor was on the PBD podcast. He actually mentioned MSTY ETF, which I own myself, and he was saying how the vol is like 100. It's crazy. What are your thoughts on it? Like, what are you hearing from your coworkers in the space there on Wall Street? I know you have a good ear, you have your ear to the ground there.
Yeah, I won't necessarily put an opinion out about, Bitcoin and crypto, but I do think there's obviously it's getting entrenched in our financial quiver of tools to use. I think I can't even call it an asset class yet, right? Because it hasn't been defined as such and it's not regulated as such. But it's certainly interesting to a lot of investors and a lot of traders. Token trading is popular among young folks.
Yeah.
I know a lot of 20 to 25-year-olds that wake up in the morning and find it more interesting to trade a token that was created 3 hours ago than to actually go into the stock market and trade. So I think that's probably on one end of the spectrum versus, say, regulated stocks, crypto-based stocks. I think that it's because it's proliferating so much into kind of what's happening in the trading community. It feels like it's here to stay. It's a real thing. Whether the use cases of all of it is up for a different debate. But we are involved with some of our funds because it's what people are interested in trading. So, we are obviously hopeful that that stays. We love the fact that Michael Saylor mentioned Misty in more than one interview, by the way. He's talked about it a few times, and I love that you called that out. So thank you for doing that in one of your
I
videos.
almost fell off my chair when I heard, I'm like, holy crap, that's the YieldMax one.
Yeah,
It
yeah,
was so
yeah. So
cool.
I think and I like the way that he positioned it too, right? It's like, hey, if you're a believer in Bitcoin, you want Bitcoin exposure, you buy MicroStrategy. Now, do you want a leverage version? Do you want an income version? You want to harvest the volatility? That's where we come in, right? It's interesting to see all of that. It's obviously, I don't want to make a 5-year prediction, but it's here for now. I think it'll still continue to grow in popularity as a trading vehicle in 2025.
Okay, fair enough. Well, that's it. You answered all my question. Maybe one final thing I wanted to ask you. This is more for myself. The implementation of the call spread strategy, which we discussed last time. Tell me how you think it's going because I see it as a huge. I could actually see a big difference, especially when I look at because in my phone, my stock watch, I have MicroStrategy and then I have Misty. So I see the movements and I see that they're a lot closer than they used to be once the call spread strategy was implemented. So I'll give you an example. If MicroStrategy is up 10% in one day, 8% or something like that, I see Misty's not far behind. Obviously, it's going to be a little bit behind because of those calls you're capping, but it's a lot closer than it used to be. Like it's not +8 and then only +2 on Misty, 2%. So what are your feelings? What are the results you're seeing with this call spread strategy? Good,
Yeah,
bad?
so it's good. It's definitely been additive. I'd love to be able to quantify that with your returns. I think you can do that on your own. I can't quote returns, but what I would tell you, I mean, it's easy enough to see them, right? Yeah, to find them. But what I would tell you is we think it's done two things. It definitely has helped us capture more or have the opportunity to capture more upside when stocks move faster than the options have predicted, right? That's the whole point of us with using implied volatility. It tells us the amount it's going to move, sell that option. And, when it goes more than that, when it moves more than that, the call spreads allow us to offset some of the cost of covering that short call. So that's been very good. The other thing it has done is we've become a lot more active in the funds because in the past you would have heard me say, well, we're waiting for the time decay to
Yeah.
to drop down to a level where we can roll. So let's say I sold a call for $1. I'm not going to roll that when there's 50 cents or 30 cents left in it. I still have a third left to make. Well, with the call spreads, the long side is now appreciating faster. And so maybe that short call has 30 cents of extrinsic, but the long call might now also have 30 cents of extrinsic. And now I go, look, I've just maxed out the most I'm going to make from a time decay perspective. I can't make any more from a time perspective. Now roll. So it is, we've become more active, and that has been helpful in what's arguably been a very bullish market since we implemented these in, uh, uh, was it September, October, right when we started doing the call spreads, and
Yeah.
the market has been up. And so it has obviously been helpful. The nice thing is, my expectation is in a down market or in a down month, shouldn't make a difference to us there either because we're still selling for the same amount of premium we did before. Yes, we had to go down a strike or two to get the right amount to pay for the long call. But okay, I'm going to make the same premium target on a down market than I would by just selling that short call. So we're hoping it's best of both worlds. We've only really seen one side of the market so far, and that has worked out well for us so far. I definitely would say we've seen a difference in the upside capture, in the performance, which ultimately goes against, the NAV decline challenge that you have with the covered call strategy when you're distributing all of the income. And I know we've
Yeah.
been through that multiple times. We don't have to cover it again here. But if you look at, Tesla or even OARC, which OARC was on a path, to continue to decline, that hasn't been the case, right? And those are two of the oldest ones, and you could
Yeah.
see the leveling out and the NAV stability there. So far, I think we've been successful implementing the call spreads.
I agree. I notice it I look at it every day. Definitely noticed a difference. And you could do these call spreads in the Target 12 suite as well, right? Okay. Yeah.
Yeah, it's actually to me, it's my preferred choice. It doesn't always make sense to do it, but it's my preferred tactic because now I'm defining exactly what I'm going to make. And if the market runs, great.
Right.
I'm capturing upside. I'm not capped.
Sounds good. Well, Jay, you've been great as usual. I hope to have you back again soon. Always excited about these new products, new product suites. So thanks again, man. Take care.
Yeah, thanks for having me on, and we'll talk when we do our next set of releases. More to come from YieldMax for sure.
Looking forward to it.
Thanks so
Take care,
much.
man. Bye.